Thanks for joining David, Kevin, Alex, and myself for the market update for the month of January. There was lots going on in January and a ton of different headlines that were racing through. The guys will break those down for you in a little bit, but I just want to give you an overall market update. Things overall were positive. The S&P 500 was up 1.37% for the month of January. The TSX was up 0.67% for the month of January. The MSCI EFI was up 4.38% for the month of January. The FTSE Canada Bond Universe was up 0.58% for the month of January. And Canada versus US dollar was plus 1.73%. So the Canadian dollar was really good in the month of January. I'm going to pass you over to the guys, but as always, if you have any questions, want to review anything, please don't hesitate to call us. Take care.
As Harry mentioned, there's definitely a lot shaping markets to start this year. All sorts of events transpiring across the globe. But for this month's market update, we thought we'd address a few of the main questions that we tend to be getting from clients towards the end of last year and heading into this year. So Alex, the first question I think most of us are getting is, are we in an AI bubble?
Yeah, thanks, David. That's definitely one we're hearing a lot here. So only time will tell whether or not we're truly in an AI bubble. AI has the potential to revolutionize how we do things and increase our productivity across the board. However, if it doesn't accomplish this, returns could be much more muted. If AI does succeed in delivering large productivity gains, this will benefit the equities market, specifically large US companies. Below is a fascinating chart which shows the adoption rate of various technologies throughout history and how fast it took for them to become mainstream. So at this time, it's really still too early to see which outcome will prevail. If AI can deliver the productivity gains, we will see a meaningful increase in the stock market. However, if not, like I mentioned, the returns could be muted. The winners of the AI race could be the data centers and the companies that are developing the GPUs and the hardware behind AI. Or it could be the companies developing the large language models and the chatbots. Alternatively, it could be other companies in other industries altogether who find out creative ways to use AI in their business to increase their productivity and reduce their costs. Some companies, like Meta, have been scaling back their capital expenditures recently on artificial intelligence in order to increase their profitability in the short term. So as long as earnings continue to be delivered in the rate they have been, this supports staying invested in the artificial intelligence trade rather than trying to time the market.
With all the political turmoil emanating from the United States and President Donald Trump, some people are asking, now is it the time to get out of the United States? What do you think, Kevin?
2025 was the first time in a long while that the mighty US stock market actually lagged global markets like Canada, Europe, and emerging markets. And the early returns so far in 2026 indicate that we may be in for the same going into the rest of this year. As advisors who advocate for globally diversified portfolios, we welcome this change or shift to a more balanced performance growth out of the global markets. We believe that this shift will probably continue into 2026 as we watch Trump continue to alienate trading partners and allies with his international trade policies. And we're also seeing that tariffs could start to have a real impact on US consumers. In fact, recent data out of the Conference Board Consumer Confidence Index is showing that consumer confidence in the US is the lowest it's been since 2014. That the figures coming in for January were down to 84.5, down from 94.2 in the previous month. So should the US consumer finally pull back in 2026, this could have an impact on corporate earnings in the United States. But despite all of that, we don't believe there should be any significant reduction to our weightings into the US at the moment. When you really look at growth in the markets, many of the largest, most profitable companies in the world are still headquartered in the United States. And those are the types of companies we want to be invested in. And that's where it's important to look at it more as an investor, because even as a Canadian citizen, we may have a disdain for the US and what they're doing right now, but it doesn't necessarily make sense from an investment point of view.
Alex, last year was a better year than it has been in quite some time for the loonie versus the US dollar. Where do we think the loonie's headed in 2026?
So, as we expected, the Bank of Canada kept its overnight benchmark rate at 2.25% in January, making it the second time in a row that they've held rates stable. The reason for this is the Bank of Canada expects that its current policy rate is reasonable enough to keep inflation around its target of 2% and keep the Canadian economy strong. So Canada's central bank did note that trade and geopolitical tensions could disrupt where rates are headed in the future. While Canada has made a lot of progress with trading partners in recent weeks, the big uncertainty that's looming is the upcoming review of the Canada-US-Mexico trade agreement. Depending on how these discussions go, the Bank of Canada could decide that it's time to either raise the benchmark rate or lower the rate. Now, in the US, the Fed has not cut rates as quickly as we have in Canada over the last 2 years. What this does is it gives the Fed a lot of dry powder in order to move the rates significantly one direction or the other if they need to. Recognizing this, the foreign exchange markets have already priced this in, with the loonie appreciating about 7% compared to the US dollar over the last year. With interest rates poised to decrease at a faster rate in the US compared to Canada for this year, we expect that the loonie will gain another few percentage points versus the USD in 2026.
Thanks, guys. As always, if you have any questions for us, please don't hesitate to reach out to any one of us. And as a friendly reminder, the RSP deadline for 2025 tax year is fast approaching now that we're in February. The deadline for 2025 is March 2nd, 2026. So if you need help making a deposit or you're unsure whether an RSP deposit is warranted or not for you this year, feel free to reach out to any one of us.
Take care.
Thanks.